wants to talk about up here. So Mike is a CPA and a partner in Acuity Advisors and CPAs. I know I've worked with Mike over the years on different farms. I know he brings a lot of unique expertise and a very valuable point of view to the table. So without much more introduction, I'm just going to say, Mike, take it away.
Okay. Thanks, Charlie. And thank you especially, Charlie, for putting the accountant between you and a shady maple lunch. So, I first got into farm transition planning about 20 years ago, and it came out of an experience in which we got in to help someone with a tax planning situation at the end of a very painful transition process. And in fact, in this particular case, the transition process for this family was to sell the farm. And we were representing one brother in that process who had the farm sold out from underneath him by another brother and mom. And we got in to help with basically pick up the pieces from a tax planning perspective. But it was a very, very poignant moment at the time, because here was a 6'2", 250-pound good farmer, and at the settlement table, once the papers were signed, and they couldn't even be in the same room, mind you. So I was in one room with my client, the other parties were in another room, and after he signed the paper, he broke down and wept, because his dream of continuing on with that farm was no longer. So it was a very, I guess, very huge learning experience for me, in that it's not really about the numbers, it's really about emotions, dreams, and what you bring to the table. And I fast forward to another experience in which there were tears at the settlement table. These were tears of joy, because the family had successfully transitioned the farm, and mom was there with a picture, with a camera, taking pictures. It was a very, very joyous and celebratory event, a very sacred moment for that family. And there were tears of joy coming from mom because of what they had transitioned and what they had accomplished. So I think it's very appropriate that you had a lot of time with Mike McGran this morning, and really going over the items that are foundational to any farm transition project. And that is really the soft stuff. And if you do the soft stuff right, the rest of it, in terms of the tools that Ron brings, I bring, Jay Clark brings, we have an easy job, because a very well-laid foundation laid by investing in the things that Mike was talking about earlier, and that Ron referred to as a legacy. By the way, if you wonder if Jay Clark and I intentionally dressed alike today, we did not. So if you get us confused, the accountant has the jacket on, and Jay's more comfortable without one. So great to be with you this morning. Thanks for everything you do in terms of putting a safe, nutritious product out there day in, day out. Myself and my family, thank you. Interesting in that, I'm just going to flip through these because John asked me when I presented at the PA Dairy Summit in February, he said, Mike, come up with a top 10 list of, as you've surveyed your experiences, what are the top 10 transition success drivers? And so I got to thinking and figured, well, I'll come up with this percentage and this ratio and that kind of thing. And actually what I came up with was the first 7 were actually really not financial things at all, but were all the soft stuff that you've heard a lot about already this morning. And finally, below the dotted line are numbers 8, know your numbers, number 9, got to have adequate profitability. I'm not going to mince words. And number 10, seeking assistance from professionals. And it's, I think the center's doing a great service by facilitating an event like this so you can get exposure to some of the tools that are out there. But I mention that again because I want to commend you for being here today to listen to some of the things that were these top 10 success drivers, many of which are not financial. And so the big three from my perspective as I've worked with a lot of farm families over the years is if there's a foundation laid that includes three things, there's a lot, the planning flexibility is a lot easier. So is there quality communication within the family and within the business? Are there positive family dynamics? How have mom and dad invested in developing positive family dynamics? What was their legacy that they got from their family? You might have heard Tom Bollinger at the Dairy Summit speak about the very painful process he went through when he was transitioned to farm from his dad. And he determined and was decided about, I'm going to break the cycle and I'm going to do it right with my son. And he invested in developing positive family dynamics that made that transition go very smoothly. And then the third thing is financial capability. At the end of the day, is there enough money to go around to make everybody happy? And that's a key thing we need to understand. If we have those three elements, what we end up having is planning flexibility that makes it a lot easier for us to take our tools out of the toolbox and put together a pretty creative plan. A couple of other observations. Some of you are junior generation, some are senior generation. Mom and dad are defined as senior generation. Son and daughter are defined as junior generation. It's my opinion that the junior generation today, if you want to have a successful farm transition, needs to be a lot smarter than their parents. And mom and dad, that might be hard for you to hear because you do bring a lot of wisdom to the table. But from a business perspective, that next generation needs to be more savvy financially than the senior generation. I met with folks last week that are looking at doing some transition work. And I asked them what their experience was when they did it. And they said, well, it was in the early 70s. Dad said, hey, let's transition things. We went to the attorney's office that changed the deed on the farm. The farm was worth about $100,000. That was it. Today's process is not that simple. Did any of you ever remember the Oldsmobile commercial? It said, this is not your father's Oldsmobile. Yeah. And the whole thing was about getting that next generation to believe that an Oldsmobile was actually a sporty vehicle and was not something that their dad would drive. Right? You remember that? And I don't know, Oldsmobile's still around, I can't remember. They're gone? Okay, well, whoever developed that marketing ploy probably is fine. Anyway, I like to say, instead of this is not your father's Oldsmobile, this is not your father's transition, and this is not your father's farming operation anymore, because the way the next generation has to go about things today is so much more complex than what it was before. There's greater risk, right? We've got milk price volatility, 25 to $10 per hundredweight. More complex business environment. In the early 70s, was there a DEP? Maybe there was, but probably not as active as what it is today. What was the banking environment back there? Back then it was, Mr. Banker, I've known you for 20-some years. You know our farm. We go to church together. I want to transition my farm to my children. handshake, deal done. Today, there's still that character part of it, but that banker's not the one making the decision. It's people sitting behind closed doors that we never get to see. Sorry, Dwight, saw you in here somewhere. In that credit department, they're big influencers in the decision-making process. So you have to be able to tell your story to somebody who doesn't know you, and somebody who doesn't care about you, because their job is to protect the bank in that underwriting department. I'm saying that a little strongly, but. And we have a much more complex tax environment today as well, right? I don't know how many pages we had in Internal Revenue Code in the 1970s, but I assure you, it's a lot more today than what it was back then. And the dollars are bigger. A $100,000 farm in the early 70s could be worth $1 million, $2 million, maybe even $3 million today. So in order to navigate where we're heading here, that next generation needs to be more financially smart than what mom and dad were. A couple comments about record keeping. I think there needs to be more and more of a premium placed on maintaining or paying to maintain quality and timely financial information. Who here is on DHIA, keeps cow records? Okay. You know probably a lot about every cow, right? Why don't you know anything about your finances? You know everything about your cows, and you get value out of knowing about your cows. Why not extend that to your financial record keeping? And maybe you do. But we've seen that there exists a direct correlation. This is true across farming, manufacturing, construction, trades, you name it, any industry. There's a direct correlation that exists between financially stressed operations and poor record-keeping practices. So my recommendation for you, especially the next generation, is not to underinvest in crafting and maintaining quality financial records. Know where you are. Are you on the right trail financially, or aren't you? We're all on a trail. The question is, are we on the right trail? Are we on the trail to financial performance and profitability, or are we on the trail to financial ruin and financial stress? Brief story. My wife and I, before we had children, we did a lot of traveling. And we went to the country of Norway, and they have a system of trails there that you hike, and then you reach an overnight shelter. I'm not talking about the shelters that are on the Appalachian Trail, where you have a sleeping bag and kind of burrow into this kind of wood shack. These were nice hotels along the trail. It was pretty neat. So in Norway, you can get up above the tree line really quickly. So the trails where we were hiking were actually, we had planned a 3 or 4 day trip along this trail system. The trail was above the tree line, and there was no path. You actually had to look for a red T to know where to go. So you get to a point, sometimes it'd be like a 300-yard, 200-yard thing of snow you had to walk across before you to get to the next tee. Anyway, a lot of suspense is taken out of this story now because I'm here and I'm alive, but we thought we were going to die. And the reason is because we started above the tree line. We started out about 1 o'clock on a trail that we thought, and their maps were on we thought was going to be about a 6-hour, 5-hour hike, because the map that they have there, this trail system, wasn't in terms of miles. It was by how long it takes you to actually hike that trail, that piece of the trail. So we left the train station about 1 o'clock. We put our sleeping bags in the train station locker because we didn't think we would need them, because In the hotel, you just have your things you're taking care of fully. And so we got our way, and soon realized as we were running out of daylight that we must be on the wrong trail. We were on a trail because we could see T's until it got dark. Then we couldn't see where we were going anymore, and we had to stop for the night in an area that was still remote. There were no trees, there was no animal life. It was like we were on the moon. And we had to hike through this like 20-yard fjord stream coming out of glaciers. And the next morning our socks were all crystallized because they were frozen overnight. Anyway, so I didn't want to look at a map, right? Then look at maps. My wife got the map out and figured out what we had done. And we were on a trail, but we were on the wrong trail. We were on the 12-hour hike trail, not on the 6-hour hike trail. So when you leave at 1 o'clock in the afternoon, you're going to run out of daylight. So that's what happened. But the best thing about that was, once we knew what trail we were actually on, we felt a whole lot better about where we were headed. That's a long story behind, if you really want to know where you are and if you're on the right path financially, you need to invest well in your numbers and know that you're on the right path. And there's several ways to make sure you're on that right trail. You need to develop accurate records and be on an accrual accounting and double entry bookkeeping system. If you really want to understand where you're at financially, you need to invest in good financial record keeping. You might know from a gut feel, and gut feel is still a good management method. Okay? You've done this many years, you have a good feel about where you're at. Nothing wrong with that. Can your banker look inside your gut? No. You have to be able to tell your story to folks that are going to be your business partners. And in a transition, guess what? You're going to have business partners. You're going to have the next generation. You're also going to have the bank, especially if you need to grow your operation and expand it to bring the next generation in for that to be economically viable. And so you need to invest in quality record keeping so you know where am I at from a percentage equity and how much of that equity is going to get converted into debt and I'm going to have the adequate cash flow. You need to understand if I expand, what's that going to look like financially or economically? Does expansion support 2 or more families at my present size? Or how big do I have to be? If you don't have a good baseline of information and a good track record of good financial record keeping on an accrual method, it makes it a lot harder to answer those questions. And I want to point out a very stark difference between accrual and cash accounting. Accrual accounting is what we want our bankers to see and what we want to see to evaluate how we're doing. Cash accounting is what we want the government to see, and the government allows us legally to report out on the cash basis of accounting. However, cash basis of accounting is great for reporting to the government, but not good for really understanding where things stand. 2014, very good year, right? In the dairy industry. In the benchmark programs that are coming out that we're part of, I think we're going to see profitability anywhere from $800 per cow up to about $2,500 per cow. Is that the profit number that we're going to report to the government? I guess you could if you wanted to, but hopefully you met with your accountant and you did prepays and you did other strategies to drive that number lower so that you're paying a much lower tax amount than what the profitability is. And back in 2007, 2008, I came across this article in Top Producer magazine, and they really explained the difference between accrual accounting and cash accounting, and how different that they are, and how inaccurate cash accounting is. Think you know your net farm income for last year? Probably not within 50% of the actual number, according to this ag economist, if you're looking at just your Schedule F. And he did a study and compared Schedule F income to actual income derived from accrual adjusted accounting. Schedule F is effective for tax planning, but it doesn't tell you anything about profitability. It does not match revenue with expenses. And what he found was that cash accounting is not within 50%, not even close to what cash accounting is not within 50% of how you're actually performing. And it makes sense because you legally adjust your Schedule F to match your income tax planning objectives, not your banker's objectives. And your banker doesn't want to be your accountant. And your banker can take a Schedule F and make adjustments, but they prefer to do banking and not accounting adjustments. So here's an example that we took. This was actually way back from '07, but it's still a good example. On this left-hand column, their accrual profit was $430,000. Guess what was showing up on their tax return? Negative 62. Try to explain that to your banker. Yeah, you can work through it and figure it out, but it's important to be able to tell your story, and accrual accounting is, if you want to be doing some transitions, it's important to really understand where you're at. Yes, sir?
Is it fair to say that accrual is always, the numbers are always better than cash? Is there ever a situation where accrual would actually be worse than cash?
The question is there ever a situation where accrual accounting actually shows a worse picture than the tax return? Yes.
Business is failing.
2009. It showed up on tax returns, underreported the losses that dairy farms were showing. Why? Because how many months of back bills were sitting there at the end of '09 that had to get caught up in 10?
Or you're living on depreciation.
Or you're living on depreciation. And so all those bills that didn't get paid in '09 didn't show up in that Schedule F until 2010 or later when they actually got paid. So yes, it can flip both ways. Good question. So some additional feedback mechanisms. Monthly monitoring, I think about some key factors. You do it with your herd metrics. I think that's important to do. Develop a dashboard of key performance indicators. 4 key measures that we look at are profitability on the accrual method, cost of production. Do you know what your cost of production is? Farming, surprisingly, is one of the few industries that underinvest in knowing what their cost of production is, because we're generally a price taker, not a price maker. So we think, well, it doesn't matter what my cost of production is because I'm going to get whatever price I'm given. That might have been true in Dad's Oldsmobile. It's not true today. You need to know what your cost of production is. And the way we boil cost of production down is, what is the Class 3 price you need to break even? Because then it gives you an indication of how competitive am I in the market. And our opinion is that if you're not below long-term a $16 to $17 Class 3 price required to break even, start doing some big thinking about whether you ought to be in the business. You need to know your cost of production. It's a Class 3 price required to break even. Remember, the price always follows the lowest cost producer. So 16 or 17 might be okay today. In 10 years, you might have to be at 15, 14. We don't know. But if you're not tracking that, how do you know? Percent equity. How much of my assets do I own? What percentage does the bank own? And liquidity. How much do I have in my war chest to work through a 2009? Coming out of 14, our opinion is that you ought to have $1,000 of liquidity per cow, which is, we define that as near cash, which is what's in your bank account and what's free and available in your line of credit. These are numbers you need to know. And then benchmark against yourself and the industry. All right, moving on to income taxes. Transitioning a farm can be real simple, and if it's too simple, it can be real expensive. Who here likes to pay tax? Stan? You like to pay tax? Why?
So I could use it somewhere else, that's better.
Keep that capital here at the table, right? At the farm. Even though you don't want to help the government out and there's a deficit there, it's your civic duty to help them out, right? In this process, we want to keep capital at the farm and not send it to the feds or Harrisburg. There's a lot of entity options out there, and this is a good time for you to be evaluating as you're going through transition, whether you have the right operating structure. And I'm going to defer to Jay to be talking more about these in his presentation. But there's a lot of options out there that you ought to be considering and getting counsel about. The other type of thing is management or entity structure. The Oldsmobile approach from the early 70s is we piled everything into a general partnership, real estate, cows, equipment, employees. That was the right structure for that time. It's no longer the right structure for today. Because of the higher risk, there's estate management tools of having your structure separate. There's ways of getting some families in, some family members that are not in a farming operation into the real estate piece, but not in the operations. There's a lot of tools out there in the toolbox that can be used in a creative plan. Here's what I mean by that, an entity structure. The top box is what things might look like today. You've got an asset base, cows, equipment, supplies, they're all in one box. The land and the buildings are all in one box. The structure to consider as there's variations, lots of variations on this. This is a pretty basic structure. But you at least want to separate the operating assets on the left, which are the cows, equipment, supplies, and employees. That's where all the risk is, right? Right here in this box is where the risk is. What's over here in this box? It's the real estate. It's where the legacy land and real estate family legacy lies. Maybe third, fourth, fifth, ninth generation. We want to be protecting the family legacy and where all the risk is. So when you have employees out in the road or you're out in the road with your equipment, that we're putting a firewall, Jay can speak more to this than I, putting a firewall between where the risk is and where the equity is. A couple of tax traps to be wary of. New entity structure. If you go from a partnership to an LLC, I won't go into all the details, just be careful. Depending on how your debt is structured, that can actually reach up and grab you. So it's just an FYI, I don't have time to go into all those details right now. Equipment sale. Depreciation recapture. It's a bad word. Be careful of it. When you sell your equipment, if you sell your equipment to the next generation, you say, you know what, son or daughter, pay me for that equipment over 10 years. The tax on the sale of that equipment is due in the sale year, not as you receive the principal payments because of depreciation recapture. Be careful. Farm real estate sales, traps in there. Single-purpose ag structures, a freestall barn, commodity shed, same deal as equipment there. You got the super fast write-off of 10 years. When you built those barns, when you sell them, they are subject to what's called depreciation recapture, which means they are 100% taxable in the year of sale, even if the payments are deferred. Be careful. Personal residence and the acreage allocation around the residence is exempt today from federal and Pennsylvania tax up to $500,000 of gain. I'll wrap up here in a couple minutes. So you want to push as much value as possible to the personal residence portion because that is tax-free. And land is maximum rate of 15% capital gain treatment unless you're over a much higher level threshold, then you get kicked into 20%. Jay.
Question for you. Planning for those two taxes, single purpose ag structure tax, the general purpose buildings, how do you suggest we plan to minimize those taxes?
Being creative. I don't have time to go into all that
That's
right now,
fine.
but maybe in the panel discussion
That
we
would
can
be a
talk
good,
about
yes,
that.
please.
So allocating the value to the extent that you can within reason is one way of approaching that. Tax efficient transfers, we want to structure payments as capital gain income because that's taxed at a lower rate. There's a gifting element that feeds into your question there, Jay, that can be helpful, and selling the farm at a discounted value can be very helpful. And
Could you expound
take
upon
questions.
that?
On
The gifting?
Yeah. Here's what that might look like. It's a bargain sale, so maybe a farm is worth $2 million. Mom and dad, after they've met with Ron, decide that they really only need an income stream based on $1 million. That $1 million, so mom and dad are willing to sell a $2 million farm for $1 million. And so that $1 million difference between the actual sale price and the $2 million appraised value, that's called a gift, which makes it a combination plan, part sale, part gift.
I mean, in the tax world, how does that look? Is that permissible?
It is permissible, yes. And I think, Jay, is that what you're going into some this afternoon?
I'll touch on it first thing.
Okay, it's basically, it links into estate planning. We are in the best time possible to be transitioning farms because of what the government has provided us in federal estate exemptions, where we can die with more, or gift in our lifetime, more than 10.5 million of assets now. Way back 15 years ago, that number was 600,000. We are in the best time possible to be selling farms at a discount to make that possible for the next generation.
How long will that window last?
How long will that window last? Let me get out my crystal ball here. I don't know. Right now, it's permanent. It's not something that's going to sunset at the end of the year. It's not something where we've had this Section 179 thing, where we never know what the law is going to be. Permanent is never permanent in Washington, D.C. Presidential budgets already are looking to scale that back.
The personal
Excuse me a second. These people are waiting to take us to lunch. We have definite time. But you'll get your question after lunch. Okay? Fair enough?
All right, sorry for taking